Hello, everyone, and welcome to a review of a seminar that we presented to our clients in Santa Rosa back in June. My name is Marivic, Hammond, Senior Investment Advisor, and joining me today are my colleagues Laurent Harrison and Rohan Nayak. Both Laurent and Rohan are certified financial planners and member of our financial planning team. Now, before we begin discussing milestones and planning for life events, there's just a couple of reminders that I wanted to let you know. First, today's presentation is available upon request. You can request copies of this presentation by calling us toll-free at 1-800-700-0089. Again, that number is 1-800-700-0089. You can also make this request via email by sending as a request at info@bellinvest.com. Again, that email is info@bellinvest.com. As I have mentioned, today we are going to talk about milestones and transitions and how to plan for them. While we certainly cannot address all of life's milestones and transitions today, we will focus on those events that we often see and plan around for all of our clients. As you all know, a milestone is a significant point in life, or as in a transition, it is a passage from one stage to another. Transitions also come in many forms and can happen without warning. Some are positive and some not so positive. Transitions can be planned, but as well as unexpectedly, so we have to think of those things that do occur very carefully. So whether it's planned or unexpected, these experiences can be very difficult, both emotionally and physically. Even with a positive experience, such as starting a new job career, has a significant impact. Take, for example, starting a new job or a career. You could be transitioning your family to a new place. You could be buying a new house. The move would also mean new schools if you have young children, as well as having an updated budget in a new location, which would add cost to the move, have new health plans, and finding other new business professionals in your new community. So the bottom line is, in order for transitions to be smooth, it's important that we create plans around them. Planning for the next stage, again, takes a very organized approach because we are faced with often tough and very difficult decisions. There are different types of plannings that we can do, that we can plan well ahead of time. There are, of course, transitions such as retirement or a career change, but others also require more of an immediate type of planning, such as a sudden job change or health issues. These events can be immediate, and these can also be evolving over time. Nowadays, we're also living longer on average. There are 76 million members of the boomer generation. 42% of that generation are delaying retirement, and 25% say that they may never retire. Our parents are living much longer, our children are staying in the home longer, and sometimes both children or parents are moving back under the same home. These major transitions require a more formal approach, and this is what we call transition planning. In transition planning, obviously, one of the key aspects is to understand those financial concerns, be they cash flow and finances, taxes or insurance, estate planning or titling when it comes to matters of legacy, as well as social security analysis for an income stream at retirement. So what are those milestones that we need to plan for? So as I've said, we cannot possibly discuss planning for every milestone and transition that occur in life, but we will try to focus on those milestones that we often help our clients plan for. These are career transitions, retirement, education planning, social security, be it in marriage, divorce, or remarriage, as well as legacy planning. When we think of these milestones to plan for, I think it's important to start by setting our goals. Setting your goals is really a journey of self-exploration and definition, knowing yourself, taking the time to figure out what you need and what you want in each stage in your life. The first step, of course, is defining what you absolutely have to have in order to take care of yourself. These are your basic needs. Now, we all know the airline's instructions to put your oxygen mask on first whenever we go on a flight. Well, the same logic applies to planning your financial future. You have to put your needs first to be able to take care of anyone or anything else. After you determine what you must have to sustain yourself, then you can explore what you want for the rest of your life, including what experiences, people, and things that make you happy. These are lifestyle discretionary choices that you want to do outside of your basic needs. And then finally, you should consider what you want to be able to do to help other people and organizations that are important to you. And you have a spouse or elderly parents, you may want to know what they want. And when it comes to community service, you might want to try and find out what you can do outside the home. So it's very important to address these questions in that order, because this is the order in which you will need the money. So at this point, let's take the next few minutes to explore some of those common transitions that we encounter most often when we help our clients plan. One of those is obviously career. So Laurent, let me turn this over to you and walk us through how you would help a client transition or plan for a career transition.
Sure, Marivic. Thank you very much. So in our practice as financial planners, we often refer to one's career as your best investment asset. So certainly as you take a look at a job change and or a career transition, you're going to be looking at what they offer in terms of benefits. We recommend that you write down what's involved in a career transition, possibly a move in terms of geographic location, but certainly there's a change in the financial area as well. One of those areas involves your 401k. A 401k contribution and a 401k plan is one of the more popular benefits that many employers offer today, and certainly if you've been contributing to your 401k, you want to take a look at rollover options from your current company to the new company to make sure that can happen. Certainly as you do a career transition, it may be that you're in your third or fourth career transition, and possibly there may be more than just one 401k. In fact, often with our clients, we find that sometimes there's two, maybe even three older 401k plans that are sitting out there, really almost forgotten, and many of them have thousands of dollars in there. So we often recommend, and in fact help, our clients consolidate old retirement accounts. So as part of your career transition, we'd recommend making sure those are components of your transition plan. With that in mind, I'll move into saving for retirement. Really saving for retirement, taking a look at your job, these are important aspects of your career transition. And so there are really two different kinds of retirement savings plans out there. The first are really employer-sponsored savings plans. The old ones were the defined benefit or pension plans. Many of these are being phased out into what we call defined contribution plans. And while they are employer-sponsored, really it's the individual's responsibility in many cases to contribute to it. So as we are saving for retirement these days, that should be a very important component of your career transition plan. Make sure that it is important and that you are contributing to your new 401ks when you move into that job. Lastly, it's always helpful to work on your emergency reserves, or really what we call 3 to 6 months of living expenses in cash before a career change, in case you need funds during your unemployment or between jobs. So again, we are advocating all of our clients to have or create an emergency reserve fund, and this can be very, very helpful while in a career or job transition. Next, I'd like to move into another type of transition, which I think most of you are probably either thinking about, planning for, or really maybe in the midst of, and that is planning for your own retirement. So this is another type of transition that can be done really or planned for years in advance. So the first option in terms of retirement planning or planning for this transition involves taking a look at typical financial details such as cash flows and budget, net worths, etc. but we also want to take time to do what we call lifestyle planning. Boomers are probably the first generation where the majority of us will live 30 or more years in retirement. In fact, that amount of time is in some cases longer than we may have worked in our working lives. And most of us that are in the boomer generation envision a very active lifestyle, which involves more than just allocating time and maybe hanging out at home relaxing.
Now, that's a good point, Laurent. And when you think of an active lifestyle and planning in a planning context, how does one build that into your retirement plan?
That's a great question, Marivic. I think I'll refer back to a New York money coach and psychologist by the name of Dr. Nussbaum, who says that retirees should plan on leaving the workforce, and that's emphasis is on the word plan. Most people think about planning with a focus on health issues or financial issues, which are certainly very important when you're working on retirement planning, but it's also important to be more inclusive, per Dr. Nussbaum. She says that what happens in retirement is a shift from an outwardizing mode to inwardizing, which means that retirees move from a culture of socializing outside the home with work colleagues and friends to one where retirees are spending much, much more time at home, focused on themselves and on what they find interesting in their own life or their spouse's personal life. It's also important to take a look at areas such as insurance policies and coverage, especially life insurance as you move into retirement. Often group insurance policies terminate, and so it's important to determine if you need additional insurance there. And certainly estate and legacy planning, which many of us look to in our 50s, should definitely be completed or really almost complete by the time you move into retirement and really kind of thinking about your estate and legacy planning then. Certainly, lastly, staying active, whether it's part-time, volunteering, really keeping busy, working with your family, working with family members is very important to maintaining a healthy physical and emotional life. Moving into another type of transition planning, what we call education planning, is similar to retirement planning in that it's a type of transition planning that you can plan for years in advance. For this type of transition, we first recommend on deciding whether you'll be perhaps funding the entire cost of a child or grandchild, or maybe part of a college education for a child or grandchild. Certainly these days, taking a look at saving for retirement versus saving for other important goals like education is a real challenging focus for many of our clients that are reaching their mid-40s to late 50s. And certainly whether you should save for retirement versus saving for education, really there's a conflict. And we call that conflict a competition for capital. So when you're taking a look at competitions for capital, what's important about this? Well, first of all, it's realistic to focus on whether you're going to save for the education or save for retirement. Certainly, if you have a financial plan in place, you've included both retirement and education. It's a fairly simple process to test for saving for both of those goals to make sure that your plan is successful. So even if you don't have a financial plan and can test for that, you probably have some sense of what you need to save for retirement, as well as what you could save for education. Certainly, if you've decided to save for education, putting a monthly contribution amount every month directly into a savings account is very important. And if you're going to put monthly contributions into a savings account, really taking a look at options for that savings, such as a 529 plan, which is a college savings plan, or a Coverdell savings plan, which is also known as an education IRA account. Those are two very important areas to look at when considering saving for education. Certainly, if you're going to take all of that time and effort to put money into an education plan, you're going to want to take a look regularly at those investments and make sure that your savings goal is still appropriate and that the investment risk is also appropriate in that plan. As we say, as your child or grandchild gets closer to college, usually you want to ratchet down the risk in those savings plans to make sure that that money is there for college or for education. Lastly, it's important not to forget about aid sources. Certainly your savings for those college goals are important, but it may not cover all of it, so take a look at areas such as financial aid. We find today that many of our clients may make a high income, and therefore they don't qualify for financial aid, but you'd be surprised at how much financial aid is available, even for those higher income earners. And certainly scholarships, especially at private colleges, are certainly being made available by those private schools much more often today with the endowments that are currently there. So definitely take a look at aid sources as part of your education plan.
Oh, thank you, Laurent. Those are really important things to remember. And as you've mentioned, career, retirement, as well as education planning is obviously something that we can plan for ahead of time. They're very evolving. But how about in cases where there is a sudden change, such as a sudden illness, or there is a death in the family? How do we then go about transition or planning for transition in this otherwise very difficult scenarios?
Well, that's a great question, Marivic. So we do recognize that you can't plan for every transition in life. So let's take an example where one spouse, this is a couple, and unfortunately one spouse experienced a sudden illness and passed away. And unfortunately, during the illness, the surviving spouse didn't have time, nor the energy, in fact, to create a transition plan. So I will point out that conversations of this type about a spouse passing away, if you can have those earlier in life, certainly during an emotionally secure time, making decisions where in an emotionally secure environment is certainly much, much easier than making them when something sudden has happened, like a spouse passing away. So again, just kind of focus on the fact that if you can make those earlier, it's better. However, if you find yourself in a situation where you've had a spouse or a significant other that's passed away, I would say the first step really in this process is to ask for help. Really look at your network, certainly asking for help from your family, whether they be children, parents, cousins and friends is very important, but don't be afraid to reach out to your professional network. So for example, your financial advisor or investment advisor is ready to help in those difficult, challenging situations. We here at Bell have unfortunately gotten the call at times to help somebody in need, and we really reach out very, very quickly and really make you a priority when any one of our clients is in that situation. So reach out to your professional network. Estate planner or CPA, reach out to them as well. I'd say next on the list would be really taking a look at your financial status. It's important to make sure where you are in your financial plan, to understand where your sources of cash might be. This is where those emergency reserves would also come into play. But certainly taking a look at maybe which assets might have been frozen, might have been maybe your spouse's assets. Some of those accounts may be frozen until essentially they're released after the reading of the will, etc. So it's important to kind of take a look at your financial status and understand where you are, and hopefully get an update if you do have a financial plan sooner rather than later. And then lastly, assessing your benefits as a surviving spouse, whether they be life insurance proceeds, or even more importantly, pension survivor income or Social Security income, is vital to your immediate planning process.
Well, thank you, Laurent. And I think it's key there is that you have some security in times like this. Certainly the income flow is one, or cash flow for that matter, is one that would be of great consideration. So this gives us a good segue to one of those aspects, financial aspects, that I think we always hear about, talk about, and that is Social Security. But I think before we go into Social Security in detail, there is one thing that we need to address, and that is what we call the Social Security myth. And it is a myth, and that is that Social Security will not be around for long. Now, when you hear this, it becomes a huge concern, especially for those who are Social Security recipients, as well as retirees or people who are looking to supplement the retirement income with Social Security. While it is certainly a very popular topic, I think we really need to look behind that statement. And Let me ask you this, Rohan. This is an area of expertise for you, and you being the in-house Social Security expert, why don't you walk us through the important aspects of Social Security and give us some examples of how getting benefits or optimizing benefits can actually supplement your income, especially in retirement?
Sure. Thank you, Marivic. We'd like to look at what's really behind this statement. Let's look at some facts. Now, Social Security has $2.73 trillion in trust fund reserves. That's a whole lot of money. At the current rate of payout, the fund is expected to be exhausted in 2033. Even after 2033, Social Security revenue is expected to cover 77% of scheduled payments, meaning the revenue Social Security collects in that year, 2033, will cover 77% of the benefits paid out in that year. Now, this may be the worst case scenario. Our federal government would likely not allow this to occur. In fact, the government previously modified the full retirement age, also known as the FRA, from age 65 to current full retirement age of 66 or 67, all depending on your birth date. So if this full retirement age was pushed back to age 70, this immediately solves the problem and makes the system solvent. So in putting together your own transition plan, we feel you should include Social Security income, as it will likely be around for much, much longer than you think. Now let's look at why Social Security should matter to you, why it's so important to you individually. Now, Social Security was designed to protect citizens when they come across difficult situations when unable to provide for themselves or their families. It is the only government guaranteed benefit to adjust with inflation for life. Think of it as a fixed income which behaves like a pension for the rest of your life. Now, you're entitled to Social Security because you're paying into it as long as you're earning income, no matter what age. The longer you work, the more you put into the system, it has a direct effect on your benefit. Timing is an important factor for the benefit. When comparing taking it early versus delaying it, you can see on the screen here, if you take your benefit before full retirement age, it can be reduced as much as 20 to 30%. And this reduced benefit sticks with you for the rest of your life. But on the other side, for every year you delay your benefits, it increases by 8%, which is a very substantial bump in your benefits. Now, the one last point I want to make on this slide is very important. Probably the one most biggest takeaway you should have from this presentation. And that is, if you're married, were married, now divorced, or a widow or survivor, just know you should be entitled, you could be entitled to a potential spousal benefit. Now, this is separate from your own benefit. Not many people know about this. Social Security does not openly publicize this, but it is definitely worth a look to see if you're eligible to collect this extra benefit.
Those are very good points. So given that there could be different rules and strategies as your marital status changes, Rohan, can you walk us through the different benefits or how those benefits are affected in cases of a marriage, a divorce, a remarriage, or even widowhood? How does that work?
Sure. Now let's start with marriage. And I'm going to use Bob and Sally as an example to explain some of the rules under each of these transitions. It's easier to understand instead of saying working spouse and non-working spouse. So Bob and Sally are a happily married couple. As a married couple, they each work and earn separately and contribute into their Social Security system on their own. In any situation, especially in marriage, you should know you're always entitled to collect on your own benefit. So Bob is entitled to his own benefit, and so is Sally. To become eligible for a full benefit, you have to pay into the system for 40 quarters, which is 10 years. Anything less than 10 years, you will not be able to collect a benefit on your own. So let's assume Bob and Sally have worked all their lives and can collect benefits on their own. Now, under the working spouse versus non-working spouse scenario, Bob and Sally, as a married couple, if both worked, are contributing into the Social Security system, they both have their own individual benefits. But one of them is also capable of collecting a spousal benefit. Now, let's say if Bob has been working and earning all his life and Sally has not. Sally is still entitled to a spousal benefit based on Bob. Sally is able to collect 50% of Bob's benefit if she applies when they both reach full retirement age. Applying when both spouses reach full retirement age is the simplest of strategies. Age at which each spouse applies is extremely important, and that can go into more complex strategies, but we will not go in that direction now. Just know you may be eligible for extra benefit, which is separate from the benefit that shows on your Social Security statement. Now, let's look at divorce. Now, let's consider Bob and Sally as a divorced couple. They're no longer happily married. They're a happily divorced couple. Both worked for more than 10 years and thus qualify for a Social Security benefit on their own. The divorce does not affect their individual benefit. Sally and Bob are still eligible to collect Social Security under their own benefit. Now let's look at Sally separately for a moment. Not only is Sally eligible for her own benefit, she qualifies to collect a spousal benefit based on Bob's benefit after age 62. Now there is this 10-year rule. You must be married for at least 10 years to be able to collect the benefit on the former spouse. So if you're getting divorced, you're on the brink of a 10-year mark, and don't divorce after 9 years and 353 days. I would suggest waiting a few more days because it is beneficial in the long term. Now, I'll leave you with one example for Sally, which is actually a real client that came to us. Sally is her fictitious name. I'll use it for the example here. So Sally and Bob are married for 11 years. Sally is 65, recently divorced, and Bob recently passed away as well. And her benefit at age 66 was $2,000 a month, and she planned on taking it at age 66. So we recommended that she make a call to Social Security and see if she was eligible for a higher spousal benefit. And it turned out her spousal benefit on Bob's record was $2,300 a month. Now, under this scenario, it meant that Sally receives $3,600 per year more under a spousal benefit compared to her own benefit. Furthermore, her own benefit continues to increase until age 70. So just being married for 10 years, divorced, and a widow made her eligible for the higher benefit. Now, let's look at the widow survivor scenario. I touched on this in my previous example here, but it is along the same lines for a widow or survivor. As a survivor, for Sally, when Bob passes away, Sally is still eligible to collect on her own benefit. But to be eligible for a spousal benefit, they have to be married to a deceased spouse for at least 9 months. So Sally cannot marry Bob, and in a month if Bob passes away, this does not allow Sally to collect a spousal benefit. This threshold is set by Social Security. They had to have been married for at least 9 months for her to collect the widow survivor benefit. As a survivor, you're first eligible to collect a benefit at age 60. It will be a reduced amount. We don't recommend it, but that is based on the situation you're in. And as a survivor, you can receive your full benefit at full retirement age. And if you remarry, you're not able to collect a benefit on the former deceased spouse. Now, there are exceptions to this, but we will not go into the details now.
Well, thank you, Rohan. And given these very different and unique scenarios, can you give us an example of how we can optimize Social Security benefits?
Sure. I'll give you one complete example of how we have performed a Social Security analysis for, these are actual clients of Bell, but I'm going to use fictitious names to protect their privacy. Let's call them Fred and Jill. Now, Fred and Jill, a married couple, age 58 and 59. They came to us, and they both figured on taking the Social Security benefits at age 62, based on their cash flow needs. At age 62, Fred had a benefit of $1,700 a month. Jill had a benefit of $1,300 a month, with with that, over their lifetime, that gave them about $854,000, assuming a life expectancy for both of them of age 88. So at this point, we suggested to Fred and Jill that they go through a complete analysis done by us, and they agreed to it. And just performing that analysis, the analysis showed a clear advantage in Fred taking his benefit at full retirement age instead of age 62, and Jill collecting a spousal benefit at full retirement age. The numbers you can see on the screen here for Fred at age 66 was $2,400 a month. Jill was able to collect a spousal benefit at full retirement age at about $1,000 a month, and then her own benefit at age 70 of $3,700 a month. So over lifetime, that number jumped up to $984,000. So in this actual scenario, our clients had an expected savings of $134,000 with this improved strategy versus the strategy they initially chose on their own.
Well, thank you, Rohan. That is certainly very significant. And I think the takeaway here is that it is important to look at your Social Security very closely, and to the extent that you can, certainly you'd want to get an analysis done. But the bigger question is this right for you at whatever point in your life? But if you are single and a married couple between age 60 and 70, I think that would be appropriate to begin thinking about this. If you're not sure when you can file, this would be a good time also to determine what those benefits would be, whether it's early eligibility, whether at full retirement, or whether you should wait until you turn age 70. And I think lastly, if you've already decided when to file for Social Security, I think it's important also to determine which strategies would apply depending on your marital status, because as clearly how Rohan illustrated, there are different rules and strategies as it applies to marriage, divorce, and also survivor or widowhood. So basic action steps that you can take at this point, first and foremost, it would be advisable to retrieve your Social Security benefit statement, and you can go online, shown on the Social Security Administration link that we have here, and also get your Social Security analysis done. This type of analysis has been a growing and a popular offer with our clients. We have done many such analyses over the last year, and it's proven to be substantially beneficial for every client that we have performed this analysis for. It is important to know what those additional benefits are, because we have found that it can truly provide a maximum Social and Security income throughout your retirement, and that makes a huge difference over a long period of time. Thanks again, Rohan. Now, at this point, I'd like to turn it back over to you, Laurent, and can you walk us through some of the steps on planning for tax and estate as well as insurance?
Sure, thanks, Marivic. Well, as I mentioned earlier, I said I would cover some tips in the areas of taxes and estate planning, and certainly as you're creating your own transition plan, these are some key areas to have. And while these topics, we could spend quite a bit of time on them, I'm going to give you just a quick few critical tips that I think you should have on your list as you create your own transition plan. So the first of these has to do with a will or trust. As a general saying goes, everyone experiences two things in life: death and taxes. While complex formal estate planning today can certainly provide a smoother road for you and your family, the creation of a transition plan along with a simple will may be all that's needed as part of your transition plan, but we certainly would consider that a critical component on your list. Next, do you have, is the titling of assets really current? You may have created a trust, for example, but we often find that clients either neglect or forget to title assets from their individual name into the trust name, and so that can be an issue late in life, as in case a spouse passes away or in case somebody passes away and the titling isn't current. So that's important to have on your transition list. Certainly, along with that and in that line, verifying or updating beneficiaries for all your retirement accounts. You may have actually done this years ago. There may have been changes in your life, changes in your family, divorce or remarriage, and certainly making sure that your beneficiaries are current. It's important, particularly for retirement accounts, since retirement accounts generally go directly to beneficiaries and can actually go directly to them, even bypassing the will and probate areas. So take a look at that. The last couple I have here are some very basic ones, but are still very critical. Certainly storing current tax and estate documents safely. Most of us might have a will, for example, in a safe deposit box, but it's important to let a family member and or friend or a close friend know where these important documents are, just in case something happens. And then lastly, in terms of taxes, it's important to keep your current tax information in one location. And also, as you're continuing to file taxes in retirement, file them on time. You don't really want to be working on those taxes on either April 14th or October 14th. And also begin that tax preparation early if at all possible. So again, if you end up going through any type of transition, particularly if it's a sudden transition, you'll really appreciate having completed the items on this list as part of your tax and estate planning transition list. The last area I'll cover has to do with a few tips on insurance planning. And certainly as we take a look at insurance, it's very important to, first of all, be organized about this. We definitely recommend that you have, for example, your health insurance, your life, disability, and long-term care, as well as your property and casualty and umbrella insurance, all in, say, they're in each individual folders. That can go a long way towards helping, again, you and your family in your transition plan. If I take a look a little bit in more detail at health insurance, for example, this is a great topic, especially in light of the Affordable Care Act that's just come out. There are many different plans that are being offered and coverage in the new Affordable Care Act. Certainly individuals that previously weren't eligible to get coverage, especially those with pre-existing conditions, will now be able to get coverage. So it's important to identify coverage and deductibles in any of the new plans that you get, or even if you're moving from one plan to another. So that would be part of my transition list. Certainly as we move into life, disability, and long-term care insurance areas, these would be the questions or areas that I would have as on my transition list. I would definitely look at identifying the type of coverage and payout options are available. Certainly when taking a look at restrictions or elimination periods, as an example, disability insurance is very well known to have essentially 90-day or 180-day elimination periods before you're eligible for benefits. That again would be great to have that emergency reserve in place if you are able, if you're ever in need or ever apply for your disability benefits and coverage. And then certainly determining any kind of waiting period for those benefits, again, is very important. The last slide before I turn it over back over to Marivic would be in the areas of, again, property and casualty and umbrella insurance. And taking a look, for example, at your home or auto insurance, it's very important every, say, 5 years to take a look at, to make sure you have adequate coverage on your home and auto. Again, these things change. You may have added an addition to your house, and it's important to have enough coverage on your home so that you're fully covered in case of any kind of an accident. And then lastly, there's a type of insurance called umbrella insurance, which is designed to add liability coverage to any of your existing policies, whether they be on your home, auto, investment properties. This is really extra coverage for any liability situation. We highly recommend it as planners. It's relatively inexpensive. It can be really important, very, very important protection in the case of a situation where you needed extra liability. And most umbrella insurance policies are available at the $1 million and can go up much, much higher than that. So for a relatively small premium, this type of insurance can bring you the protection you need and really some wonderful peace of mind. So with that, I'm going to turn it over to Marivic to complete the presentation.
Well, thank you so much, Laurent. And as we all have talked about today, I mean, there certainly are many transitions that we can think of above and beyond what we covered here but what we've illustrated hopefully demonstrates what most people plan for, most concerns that we encounter. So to really think about succession planning, or successful planning rather, for milestones, I mean, some of it do require stage or an evolving process. And the bigger question is, how do you even begin? Where do we start? So I think if we have to go back to our initial slide on setting goals, I think this diagram again illustrates how we can successfully create a transition plan. I think first and foremost, understanding what our goals are is the key. If we take the time to reflect on what we want, we can certainly understand where we're headed. We can start with very simple, easy steps to follow. I mean, the more important thing is you start small and then you start now. When we create our plan, it's also important to focus on our financial stability. Again, looking at the diagram, we want to understand first, what do I need? Those cover basic needs such as food, shelter, and healthcare, for example. And then you moved on to the next goal, which is, what do I want for myself? Now, these are discretionary items, be it travel, be it a new hobby, be it health and fitness, or maybe what you can do in your retirement community if you are in such a situation. And lastly, what do you want for others as part of the plan? Now, this may cover what your spouse may want, your children and grandchildren, how you can help elderly parents. This could also cover legacy and philanthropy if such a charitable intent is part of your plan, and also community service. What do you want to give back to the community? So the important thing is to focus on financial stability. And we often say to our clients, well, pay yourself first. And you can do that whether it's retirement savings or your cash reserves. Above and beyond this, it doesn't have to be overwhelming. So this is the case where you can ask for help for sure. Use professionals. We here at Bell Investment Advisors are always ready to help our clients understand, articulate, and clarify what these goals mean. Seek out help from your estate planners as well when it comes to legacy and estate planning, or even your accountants, so you can be better prepared for what tax impact there may be in either your career or business life. More importantly, I think it's clear now that you need to stay active and keep some parts of your life rather consistent, because it's not always going to be an easy road. There will be bumps, but after all, it's about the journey and not the destination. So this ends the formal part of our presentation. I want to thank again my colleagues Laurent Harrison and Rohan Nayak for joining me today. As we have mentioned earlier, portions or all of these slides can be available upon request by calling us at our toll-free number of 1-800-700-0089, as well as an email request at info@bellinvest.com. Once again, you don't need to wait for the next presentation to stay in touch. You can always access our interactive website at www.bellinvest.com. You can also check out our financial blog at financialadvisorblog.bellinvest.com. Bonnie Bell also has her own blog at careerlifecoaching.bellinvest.com. We update our Twitter account, and our handle is bellinvest.com. Thanks again for joining us today. Hope you have a good day. Thank you.